Listen to me very carefully. If you woke up today, checked the chart, and thought Bitcoin's just chopping, you're already behind. Because while everyone's staring at that cute little price line, zooming in, zooming out, refreshing like it's going to say something different, the market just did what it always does right before a real move. It went hunting, and it found blood. In the last 24 hours, roughly $90 to $150 million in long positions got wiped out. Just deleted, gone, wrecked, like they never existed. And at the exact same moment, the fear and greed index is sitting in extreme fear territory. Now here's where most people tune out, because they think fear means it's over. But that's exactly backwards. Extreme fear is not where Bitcoin dies. It's where Bitcoin sets traps. And the trap I'm watching right now is sitting right underneath a number that sounds innocent, but it's basically a psychological landmine. $70,000. $70,000 isn't just a price level. It's a headline. It's a brag. It's, I told you so. It's, my spouse finally stopped making fun of me. It's, maybe I can finally breathe. And when Bitcoin gets rejected from a level like that, after leverage has already been partially flushed, you're standing at a fork in the road with two very different destinations. Destination 1, this rejection quietly turns into a bleed. Price drifts, slides, and then one day, suddenly, everybody's texting you, bro, is Bitcoin dead? And you're staring at $65,000, wondering why you didn't take the setup seriously. Destination 2, the market does what it does best, what hurts the most people, and rips violently upward. A squeeze so fast and so nasty it feels almost illegal, and everyone who panic sold watches it run without them. So which is it? Are we setting up for the slow bleed to 65K? Or the squeeze that makes the bears go quiet real quick? I'm going to show you everything, the data, the psychology, the patterns, and the exact tells I watch. Not theory, experience. But first, and I mean this, let's get the disclaimer out of the way because I actually care about the people watching this. I am not a financial advisor. Nothing in this video is financial advice. I'm someone who has been in this market long enough to get hurt by it, learn from it, and eventually understand it. And I share what I see for education and perspective only. Your money is your responsibility. Always do your own research. Always talk to a licensed financial advisor before making any real decisions. No exceptions. We clear? Good, because now we can go deep. Let me paint you a picture. It's early morning, coffee's brewing. You open your phone, pull up the chart, price looks normalish, not crashing, not mooning, just there. So your brain relaxes. That's the first mistake. Because Bitcoin doesn't announce the punch. It just hits you. And then you're replaying the last 12 hours going, wait, what just happened? Here's what happened. The market leaned too hard on leverage. If you're newer to this, leverage is basically borrowing speed. It's like driving a sports car on black ice because you want to get somewhere faster. Feels incredible until you tap the brakes wrong. And those long liquidations we saw, that's the black ice moment. Somewhere between $90 million and $150 million in leveraged long positions got washed out over the last 24 hours. That's not just a number. That's thousands of people who were confident, people who thought, we're obviously going up. And when those positions get liquidated, they don't close politely. It's forced selling, an automatic trapdoor under your feet. The system doesn't ask if it's a good time. It just closes you out at whatever price the market is trading. And you can feel it. You can literally feel the mood shift in crypto when that happens. Group chats get quieter, Twitter gets nastier, Reddit gets dramatic, and the fear and greed index sitting at extreme fear, that's the emotional confirmation. That's the crowd saying, I don't feel safe. Now let me take you back for a second. Back in 2021, I made the mistake of thinking fear meant it's over. I remember watching a nasty wick down, thinking I was being smart by protecting capital, selling right into a flush, and then watching Bitcoin snap back so hard, it felt like the chart was laughing at me. That's the thing about Bitcoin. It's not just a market, it's a psychological arena. It's a machine that transfers money from the impatient to the patient, and it does it by weaponizing your emotions. Fear, greed, hope, regret, and right now the market is serving a very specific cocktail. Leverage pain plus fear vibes plus a big shiny number overhead, 70K that everybody wants and not everybody gets. Now here's what the data is actually showing beneath the surface, because price is only half the story. Let's start with open interest. Across Bitcoin futures globally, open interest is sitting in the tens of billions of dollars. It's cooled slightly from recent peaks, but it's still elevated enough to confirm that leverage is very much alive in this system. Here's why that matters. When open interest drops alongside price, it signals that positions are being flushed. That can actually be healthy. It resets excess speculation and clears the overcrowded trades. But when open interest stabilizes while price struggles, that means traders are repositioning. not exiting. And repositioning can set up the next explosive move in either direction. The key question right now is whether this recent drop represents a completed deleveraging event or just the first phase of a broader unwind. Next layer, funding rates. Most casual viewers skip this completely. Funding has normalized, and on several major exchanges it's actually flipped slightly negative. Negative funding means shorts are paying longs. What that tells you is that the short-term market bias has tilted bearish. When funding flips negative after a liquidation event, it usually means sentiment has shifted very quickly from optimism to caution. That kind of rapid emotional swing is textbook behavior after sharp rejections from psychological levels like $70,000. But here's the twist. Extreme negative funding combined with stable price action can become fuel for a short squeeze. If price refuses to break down while shorts are aggressively building positions, even a modest upward push can trigger a chain reaction of forced buying as shorts scramble to cover. Now let's talk about what nobody is actually discussing. The chart is only half the game. The other half is what traders owe the market. And when I say owe, I mean this. If too many people are positioned one way, the market can move a small amount and force them to close, which creates more movement, which forces more closing. It's like a domino line. And liquidation data is basically the sound of dominoes hitting the floor. So when you hear 150 million longs wiped, don't just hear a number. Hear a crowd getting forced out at the worst possible moment. Now ask yourself, if all those longs got wiped, who's left? The strong hands? Or the next layer of overconfident gamblers who think, okay, now it's safe to go long again? Because that's how leverage flushes keep going. They don't end with one big candle. They end when the crowd finally stops reaching for the stove. And extreme fear? That can mean the crowd is backing off. Or it can mean they're scared but still addicted. You ever seen someone say, I'm done trading? And then 2 hours later, they're back in a 20x position? Yeah, that. So the first thing I watch is whether the market keeps producing these sudden wicks. Those wicks are usually the fingerprints of leverage still getting rinsed. And if you're sitting there like, why is Bitcoin doing this to me? It's not doing it to you. It's doing it to the people who need it to go one direction immediately. And if that's you, I'm not judging. I've been that guy. But that's how you get wrecked. Let me make the leverage concept even simpler. Think of leverage like a crowded elevator. If everybody piles in and the cable starts snapping, the first shake doesn't just scare people, it makes people hit each other trying to get out. That's liquidation. And when enough people are forced out, the elevator suddenly has space again. That's when it can move smoothly, up or down, without everyone screaming. Extreme fear is the screaming. $150 million longs wiped is the people getting shoved. 70K rejection is the elevator refusing to go to the penthouse for now. Now let's pull in the institutional picture, because this is where the analysis gets deeper than what most people are watching. Spot Bitcoin ETF inflows, which had previously provided steady structural demand, have slowed in recent sessions. That doesn't mean institutions are exiting en masse, but it does mean the marginal buyer pressure near $70,000 has softened. ETF flows represent real capital, not leverage, and they often drive medium-term trend stability in a way that leveraged futures positions simply cannot. When ETF inflows are strong, dips get absorbed with confidence. When inflows cool off, resistance levels become significantly harder to break because there's less passive demand supporting upward momentum. If ETF inflows reaccelerate while price remains below $70,000, that would materially strengthen the bullish case. Conversely, continued muted inflows combined with rising exchange deposits, that creates overhead supply pressure that can weigh on every rally attempt. On-chain data gives us another layer. Exchange reserves have shown intermittent increases following recent volatility, suggesting that some larger holders have transferred coins to exchanges. Transfers to exchanges don't always mean immediate selling, but historically they are associated with elevated near-term distribution risk. Long-term holder supply, however, remains relatively stable. Older coins are not aggressively moving. That divergence matters enormously. It tells us that short-term participants are more active right now than long-term investors. And that distinction is critical because long-term holders typically anchor the broader trend structure. If long-term holders begin distributing meaningfully, that would represent a structural shift, not just a tactical correction. Stablecoin supply dynamics also matter more than most people realize. The total stablecoin market cap remains substantial, representing significant potential buying power sitting on the sidelines. But the key metric isn't total supply. It's inflows to exchanges. When stablecoins move on to exchanges, they often precede buying activity. If stablecoin exchange balances rise while Bitcoin consolidates, that suggests dry powder is preparing to deploy. If stablecoin balances stagnate or decline during consolidation, buyers are not aggressive. Liquidity readiness often determines whether consolidation resolves upward or downward. This is the difference between a base that launches and a base that cracks. The options market adds yet another dimension. Implied volatility has ticked higher during recent swings, reflecting genuine uncertainty about the next directional move. Put-to-call ratios have leaned slightly defensive, indicating more downside hedging activity. Here's the paradox that most people miss. When traders heavily hedge downside risk, the market can actually stabilize because much of the selling pressure becomes pre-positioned rather than reactive. The fear is already priced in. But if that hedging unwinds too quickly and price fails to recover, that can amplify downside momentum as protection gets removed at exactly the wrong moment. And we can't ignore macro conditions. The US dollar index and Treasury yields influence global liquidity. A stronger dollar and rising yields typically pressure risk assets, including Bitcoin, by tightening financial conditions. Equity markets play a role too. When the S&P 500 trends higher with low volatility, crypto tends to benefit from risk-on sentiment. When equities wobble, crypto often amplifies that weakness with leverage. Bitcoin no longer trades in isolation. It exists within a broader liquidity ecosystem. And ignoring that context is how people get blindsided. So let's put all these layers together right now. The current environment reflects a market in transition, not in clear breakout mode. Price rejected near $70,000. Leverage was partially flushed. Sentiment turned fearful. ETF inflows slowed. Short positioning has modestly increased. That combination creates two primary pathways, and one hidden third path that most people never see coming. The first pathway is continued downside testing toward the $65,000 region, where additional liquidity clusters and stop levels likely reside. If price drifts lower while open interest declines further, that indicates continued deleveraging. That can eventually set up a healthier base, the kind of base that holds. The second pathway is the squeeze scenario. If price stabilizes above recent lows while funding remains negative and shorts keep building exposure, a sharp reclaim of $70,000 could trigger a chain reaction of forced buying that accelerates momentum upward far faster than anyone is prepared for. So why does 70K matter so much psychologically? Because round numbers are where humans do the dumbest things. It's where they FOMO in. It's where they brag. It's where they oversize. It's where they open a quick 10x leverage long, because we're definitely breaking it this time. And if we get rejected there, it's like trying to kick open a door that's bolted. You hit it once, twice, 3 times, and then you're tired. And that's when the door hits back. Does that automatically mean we're dropping to 65K? No. And this is the part that separates tourists from people who actually survive cycles. Bitcoin can reject a level and still be bullish. Bitcoin can flush leverage and still be bullish. Bitcoin can scare everybody and still be setting up the move of the month. So what's the real question? The real question is, did the leverage flush finish the job, or is it still happening? Because if it's still happening, you're going to see more random dumps that don't make sense. And if it's done, that's when the market gets quiet and then violent. There's a reason I'm so focused on the violent squeeze possibility, because squeezes happen when the crowd flips too hard. 1 minute, everyone is bullish. They get punished. They flip bearish. They open shorts. They post charts with red arrows. See? Told you. Sentiment gets darker. Extreme fear deepens. Then Bitcoin holds a floor, some level where sellers run out of ammunition. And once sellers are out, even a small push upward becomes a chain reaction. Shorts cover. More shorts cover. Price accelerates. And suddenly you're looking at a candle that makes your stomach drop, but in the opposite direction. That's the violent squeeze. And if you've never experienced one, it feels like missing a flight you were standing at the gate for. You were right there. You just hesitated. US market hours matter here too. Liquidity changes. The tone shifts when New York wakes up. You can have a sleepy overnight move that sets the stage. And then the real shove happens when the US session gets going. So if you're watching this in the morning or midday US time, understand, you're not just watching a chart. You're watching a crowd. And crowds are emotional. They overreact. They get trapped. And Bitcoin loves trapping crowds. Here's something I learned the hard way. You don't need to predict the future perfectly. You need to know when the market is primed. A leverage flush plus extreme fear plus a major psychological level overhead, that's prime. That's dry wood and gasoline. All it needs is a spark. The spark could be nothing. Literally nothing. Just one push through a level and the dominoes start falling. So what should you be watching? Not news, not random influencer tweets. Watch how price behaves around key zones. Watch whether dips keep getting bought quickly or whether they grind lower. Watch whether pumps get slapped down instantly or whether they hold. Because those are tells, those are the market's body language. And body language is harder to fake than words. Now, and I want you to really hear this, this is the one line that saved me years of pain. The market does what hurts the most people. So ask yourself, what hurts the most people right now? Does it hurt more people to dump to 65K and wipe out late longs? Or does it hurt more people to rip back up and embarrass everyone who panic sold and shorted the bottom? That's the lens. That's how you think about this. Not as prediction, but as probability weighted by pain. All right, let me give you the roadmap now. Not a prophecy, not a guarantee, a roadmap. Because the worst feeling in crypto is not losing money. It's losing money while being confused. So here are 3 scenarios. The bearish case, the bullish case, and the surprise, and exactly what would trigger each one. The bearish scenario trigger. Bitcoin keeps getting rejected under 70K, and every bounce gets sold fast. What it looks like, you'll see little pumps that feel hopeful, and then they fizzle. The chart starts to feel heavy, like someone sitting on it. The dips stop bouncing as high, the floor starts cracking, and then one day, maybe during US hours when liquidity is thick, Bitcoin slips, stops out the crowd, and you start hearing that ugly word again, capitulation. What a disciplined person would do. Stop trying to win every 15-minute candle. Protect your mental game. Have a plan for how you react if 65K prints, instead of reacting like it's the end of the world. Because sometimes 65K isn't the end. Sometimes it's the cleanup, and cleanups can be where long-term conviction gets rewarded, but only if you don't get emotionally destroyed on the way down. Ask yourself right now, if Bitcoin hits 65K tomorrow, would you be calm, or would you be making decisions out of fear? That's the real test. The bullish scenario trigger. Bitcoin stops dumping on bad vibes and starts holding dips. It refuses to go lower. Then you get a push towards 70Ks again, and this time it doesn't instantly get slapped. You see price hover, grind, hold. That's the tell. When Bitcoin stops rejecting and starts accepting a level, it's like a bouncer finally letting you into the club. It's subtle at first until it's not. What it looks like, a break over 70KI that feels too easy. People doubt it. They say fake out. They short it. And then it keeps going. That's the squeeze fuel. The move accelerates because disbelief is gasoline, and the longer everyone stays skeptical, the farther it can run. What a disciplined person would do. Stop obsessing over being right. Focus on risk. Think in scenarios. Avoid chasing green candles, because the squeeze will tempt you. It'll whisper, you're missing it. And that's how people buy tops. You don't need to chase. You need to recognize there's a difference. The surprise scenario trigger. Bitcoin stays stuck under 70K, but refuses to break down to 65K cleanly. It just chops. What it looks like, the chart becomes a blender. One day it looks bullish. Next day it looks bearish. You get wicks in both directions. Everyone feels personally attacked. This is the market harvesting impatience. This is where traders get chopped up and long-term holders get bored. And boredom is dangerous too, because boredom makes you overtrade, revenge trade, and open leverage just to feel something. What a disciplined person would do. Zoom out, reduce noise, and remind yourself that the market's job is to make you emotional, and your job is to stay rational. Because if you can survive the chop, you usually get paid when the breakout finally happens. And breakouts almost always come after the most boring, most annoying price action. That's why they work. The market exhausts you first. Then it moves. Now, what ultimately determines direction is not news headlines. It's liquidity and positioning imbalance. Price moves when one side of the market becomes too crowded. If too many participants expect a breakdown, the market may deny them. If too many expect a breakout, resistance stiffens. The market's function, its actual job, is to transfer capital from emotional participants to disciplined ones. That transfer happens through volatility and surprise, every single time. If Bitcoin can get above 70K and hold it, that's the market saying we're not done. If Bitcoin loses its footing and slides towards 65K, that's the market saying we need to clean house. And there's no shame in either scenario. The shame is getting surprised by something you could have been ready for. Now let me bring this full circle some, because I want to tie all of this back to something that actually matters. Real life, rent, groceries that somehow cost twice what they used to, a college fund for your kids, a retirement that isn't just a hope and a prayer. Bitcoin, whether you love it or hate it, has become part of that story for millions of people. That's why these moves hit different. It's not just a chart, it's your future. And the market knows that, so it tests you. It tests your patience, it tests your conviction, it tests whether you're here because you understand what you own or because you wanted a quick pump. I'm not saying that to judge you, I'm saying it because I've been both. I've been the guy chasing candles like a maniac, thinking I was early when I was really just emotional, and I've been the guy who finally learned to slow down, breathe, and treat this like a long game. The next 24 to 72 hours are likely to provide real clarity, because consolidation near psychological levels rarely lasts indefinitely. Breakouts from compression tend to be decisive. Pay attention not just to whether $70,000 gets touched, but whether it gets accepted. Acceptance means sustained trading above the level with expanding volume and supportive derivatives data confirming the move. Rejection means quick wicks and immediate pullbacks accompanied by rising short positioning and declining ETF flows. In summary, Bitcoin is not simply chopping, it is recalibrating after a significant leverage event within a high emotion environment. The data shows partial deleveraging, cautious sentiment, slower institutional inflows, and balanced long-short positioning. That is a setup capable of resolving in either direction, depending on which side becomes overextended next. The key is understanding that price is the result, not the cause. Positioning, liquidity, and psychology drive the move, and those forces are actively shifting beneath the surface right now. Extreme fear is not a price signal, it's a people signal. It's the crowd telling you they're uncomfortable. And when the crowd is uncomfortable, they do predictable things. They sell bottoms, they short late, they hesitate when opportunity shows up, they get loud when it's too late. So if you take anything from this breakdown, take this. You don't need to be a genius to survive and win in Bitcoin. You need to be emotionally stable. You need to be able to say, I don't know exactly what happens next, but I am prepared for multiple outcomes. That's maturity. That's how you stop donating to the market. And I'm going to be honest, there are moves happening behind the scenes right now, in the positioning data, in the flows, and in holder behavior patterns that can make this entire 70K versus 65K debate look small in comparison. I'm going to break all of that down in the next video because if you think the leverage flush is the whole story, you're missing the second act. And the second act is where the big money usually gets made or lost. This market doesn't care about your feelings, but I do. That's why I make these breakdowns. Stay sharp, stay humble, and don't let a random candle bully you into a bad decision. If this opened your eyes even a little, if you see something now that you didn't see before, hit that notification bell. Not for me, for you. Because the next time something like this happens, and it will happen, I want you to be the first to know. Not the last, never the last. One last thing before you go. I want one word from you in the comments, just one. 70K if you think Bitcoin reclaims and holds it first and we get that squeeze, or 65K if you think we tag it first and the market needs one more rinse cycle. No essays, one word. Let's see where this community stands right now. And if you've been through a leverage flush before, if you've got a scar from 2020, 2021, 2022, any cycle, drop one sentence. What's the hardest lesson you learned? Because somebody reading your comment is about to learn that lesson the easy way, from you, instead of the hard way, with their money. My next video is going to be about something almost nobody is talking about until it's already on CNBC. And when it hits mainstream, people are going to act shocked. You heard it here first. Stay sharp, stay ahead. Peace.